Works is contemplating a purchase of a new milling machine. The purchase price is $60,000, so that's a cost. And its annual operating cost is $2,675.67. So that's annual, so that's going to be every year. For the life of 7 years, so we have a whole 7 years here. And it is expected to generate $15,000 in revenues each year of its life. So we have $15,000 in revenue here for each year. Besides the first year, like the first starting, we have it for the first year, but not for like the first starting time when you buy it, because 0 is when you buy it. So they make $15,000 here, they make $50,000 here, so on. So first, we calculate the annual cash flow. So for the 0th year, when we first buy the machine, we're not making any money, we're just spending money on the machine. So the annual cash flow is just going to be that negative $60,000. For the rest of them, it's going to be the cost minus the revenue. So this $15,000 minus this $2,675.67, and that's going to be $12,324.33 for all of the years. We just looked out that all of them are the same for every year. And so they are all going to be this. But it's just this minus this. And the present value of each cash flow is calculated by doing this cash flow over 1 plus the rate to the number of years that it's been, number of years away that it is from currently, 0 being current. So we're going to do that for every single box here. So for instance, with, let's just say for the second year of 10%, what we did was this cash flow, $12,324.33. And then we did it over 1 plus 0.10, which is going to be 1 plus the rate, 0.10 being 10%, to 2 year, to the 2 squared. So, and then we would get this number, this 10,185. And then, but we did that for every single one of them with the corresponding numbers. And that gives you the annual net present value for each thing. So that'd be the annual net cash flow for this. So on. And then to get the net present value of the whole investment given a specific discount, you sum up all of these. So this box is the sum of all of this row. Same with this box. This box is the sum of all of this row. And this box is the sum of all of this row. So these are our net present values, and then we're going to use those to do some analysis on whether Southeastern Louisiana Metal Works should buy this machine. What is the present value of the 7th year annual cash flow if the discount rate is 8%, 10%, 12%? So that's just going to be these 3 numbers for 8%, 10%, 12%. Calculated the same way as before. What is the net present value of the investment as a whole? So that's going to be these 3 numbers. So those are the sums of all of the whole rows, including this negative number from when we first invested in the machine. Okay, so interpretations. If the discount rate is 8%, the machine is worth investing in. And the reason for that is because it is a positive number. It's positive by a lot. It's positive by $4,000. And so they will be making money off of it. Definitely. Over the discount rate, which involves interest. So they will be making interest and additional capital off of it. And then the other easy one to answer is if the discount rate is 12%, Southeastern Louisiana Metal Works should not invest in it. They would be losing money if the discount rate is 12%. they would still, if we don't account for interest, they would still be making money. But that's not what financial investors really will look into, because they have to calculate the risk of investing the money in the first place, and that 12% incorporates a lot of that. So they would be losing money in opportunity cost and risk and the cost of capital. Now, 10% is the one that requires more deeper thought into it for the company. So they would break even given the interest. So they should think about if this investment is going to help grow their company, if this investment is going to give them a market share that they're looking to get, if it's going to give them other benefits outside of just the investment factors, or if it's going to be like a lot of work or other, it's going to have any negative effects on the company. They need to do more analysis involving more factors to determine whether or not they should invest. So the lower the interest discount rates are, the more value individuals are placing on future dollars. And if you look at these numbers, you can kind of tell. So the lower the interest rate, so 8% is lower than 12%, right? And the 8% is very clearly, the 8% is very clearly higher. This 4,165 is very clearly higher than 0 and 3,754. We're valuing that number higher if that interest rate is lower. And individuals that are impatient and want quick returns might be described as having high discount rates. They want a very fast return, so they're going to value money that's further away lower because they want a faster return. Time is, the longer something goes on, the less value it's going to have in the present. So somebody who wants very fast